All financially regulated businesses established within DIFC are classified into 5 main license categories. Based on the type of financial activity, the level of risk, and whether you act as principal or agent. The category defines what you are allowed to do, how your business is structured, and the level of governance, capital, and regulatory oversight required. My name is Shiraz Waheed, and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain the 5 DFSA, that is the Dubai Financial Services Authority's license categories, how each one works, what activities they allow, and how to determine which structure fits your business model when operating within DIFC. Before going into each category, it is important to understand what this regulatory layer is designed to do. The Dubai Financial Services Authority, also known as DFSA, regulates financial services conducted in or from DIFC. DIFC is fully regulated financial center with defined rules around capital, compliance, governance, and supervision. Because of this, the license category you choose defines your operational boundaries, risk exposure, and reporting obligations, and how banks and counterparties assess your business. Now let's start with category 1, which you can think of as deposit-taking bank license. It is the most restricted in terms of who can apply, but it is also the most systematically important. This category allows a firm to accept deposits, which is traditional banking activity where you take money from clients and hold it on your balance sheet. Because of the systemic risk involved, the capital requirements are significantly higher, governance is more complex, and risk management frameworks must be robust. The DFSA expects detailed oversight, including liquidity management, capital availability, and internal controls aligned with international banking standards. This category is used by banks or institutions that operate at large scale and is not typically relevant for most entrepreneurs or family offices, but it sets the highest level of regulatory responsibility within DIFC. Now, category 2, commonly known as principal trading license, moves away from deposit taking and focuses on dealing in investments as principal, meaning the firm trades on its own account and takes positions using its own capital. This introduces market risk rather than deposit risk, so the regulatory focus shifts accordingly, with capital requirements structured around trading exposure instead of client deposits. In practice, this category is used by proprietary trading firms, market makers, and institutions actively participating in financial markets using their own balance sheet, with governance focused on risk limits, exposure monitoring, and internal controls around trading activity. For entrepreneurs, this becomes relevant when the business model involves active trading strategies rather than advisory or execution services. Category 3, often known as an advisory and asset management license, is one of the most commonly used licenses within DIFC and allows firms to deal in investments as agents, manage assets, provide advisory services, and arrange transactions. Instead of taking positions themselves, firms act on behalf of the clients by managing portfolios, providing investment advice, or arranging deals between parties. The regulatory framework reflects the intermediary role, with continued requirements for capital, compliance, and governance, but with a focus on client protection, suitability, transparency, and proper handling of client assets. From a structuring perspective, this category is often used alongside foundations, trust, or holding structures. For example, where a family office uses a Category 3 license to manage assets held within a DIFC foundation or offshore structures, creating a coordinated governance layer with clear separation between ownership and management. Banking relationships also become more structured at this level, with banks assessing both the license and the governance framework around the client assets, including custody and operational control. Category 4, which functions as arranging an advisory license, is more limited in scope and allows firms to arrange deals in investments, advise on financial products, and provide arranging services without managing assets or hold client money. This reduces the regulatory burden compared to Category 3, but also limits operational capability, as execution and custody typically sits with other regulated entities. In practice, this category is used by corporate finance advisors, investment consultants, and firms focused on structuring rather than direct asset management. From a governance perspective, it often works alongside external asset managers or custodians, where the advisory firm focuses on strategy while counterparties handle execution, improving clarity but requiring strong coordination to avoid gaps in control. Category 5, known as Islamic Finance License, is specific to Islamic financial business and allows firms to conduct Sharia Sharia-compliant financial activities. It does not represent a different type of service, but instead overlays Sharia compliance onto existing financial functions such as asset management, advisory, or investment structuring. This introduces an additional governance layer through a Sharia supervisory board, which ensures that all activities, documentation, and operational processes comply with Islamic finance principles. In practice, this category is used by firms targeting clients who require Sharia-compliant solutions, adding governance rather than replacing the underlying financial activity. As you consider these categories, the key point is alignment. The license must reflect what your business actually does, not what you plan to do in general sense. Regulators, banks, and counterparties will assess your activity against your license, and any mismatch here creates risk. This is particularly important when your structure involves multiple jurisdictions. For example, you may have holding structures in DIFC, operating companies in other countries, and investment portfolios held globally. The DFSA license must fit within the broader framework. Banking also plays a key role. Banks in DIFC and internationally will look at your license category, governance framework, and operational model. A well-structured Category 3 or Category 4 entity with clear control is often easier to bank than an entity with unclear activity or mismatched licensing. Ultimately, the DFSA categorization system is a framework for defining how your financial business operates, how risk is managed, and how control is maintained across your structure. When designed correctly, it supports credibility, cross-border coordination, and long-term continuity. When it is misaligned, it creates friction at multiple levels from banking to compliance and operational execution. Now, if you want our help and would like to structure a DIFC financial regulated firm in any of the category license that we have discussed, you can reach out to us using the link in the description below. That's it for today, and I will see you in the next video.